What's going on, everyone? In today's video, we're going to talk about 5 ways you could purchase a home with little or no down payment in 2020, so you could be one step closer to getting that new property this year. Down payments are usually one of the biggest issues for people when it comes to buying a new home, especially if you live in New York like I do, or other expensive areas such as Denver, DC, California. Then coming up with 20% could get expensive really quickly, to the point where people just say, you know what, f it, I can't afford this, I'm just gonna keep on paying rent. And then they look back 10 to 15 years later and be like, damn, I should have bought that house. So in today's video, we're gonna talk about down payments, specifically how to avoid putting down large down payments. That way you could get into that new home a little bit quicker with less money. For those of us who don't know, according to Google, a down payment is an initial payment made when something is bought on credit. For example, there's a car that costs $50,000, but you don't have $50,000 in cash at the moment, nor do you want to spend $50,000 at one time on the car. So you go to the dealer and you say, hey, I don't have $50,000, but I have a $10,000 down payment if you let me drive off the lot with this car right now, and I'll pay you monthly over time until the car is paid off, and I'll throw in a little bit of interest for your troubles. I'm going to run down my 5 current favorite programs if you are attempting to get into a home with little or no money down. I'll go over which program I use and why I chose to use this program versus the others. Also, the pros and cons of each, so that you can have a better idea of what may work for you in your situation or even in your area. Let's jump into my 5 favorite no down payment and low down payment options for 2020. And let me just say, I'm not a lender, a CPA, an attorney, or a financial advisor. Anything that I say after this is simply for entertainment purposes only. Now that we got that out the way, the first option I'm going to discuss is the Chase DreaMaker mortgage. I'll outline some of the pros and cons that I found with this program and why I like it versus why I don't like it. One of the main reasons I like this program is because a credit score of just 620 can get you into a home with 5% down. Now, you could get into a home with this program with as little as 3% down if it's a single family or a condo. Also, the Chase DreaMaker mortgage allows you to use the Chase Homebuyer grant in combination with it to get an additional $2,500 that you can use towards your down payment and or closing cost. So on top of only putting down 3 or 5%, you'll have an additional $2,500 to even reduce that initial down payment cost that you were planning on spending. Another great pro to this program is you don't necessarily have to be a first-time buyer. So if you happen to use an FHA loan to get your first home with the 3.5%, you could then use this to get another single family with 3% down. Possibly my favorite reason for the Chase DreaMaker mortgage is because you do not need to have reserves at the time that the mortgage closes. Now, this will be very important later on in the video, and I'll explain why this is important. But basically, reserves are funds that you need to have liquid in your account or easily accessible prior to closing, so that they can see if maybe you got a multifamily unit building and it gets vacant, how will you pay for that mortgage on your own? Are you capable of taking care of that mortgage? If something were to go wrong with the roof or the boiler or any high ticket item, can you afford to pay for this item? But not everyone has a high amount of reserves, especially if they're attempting to use a low or no down payment option. And another reason why I like the Chase DreaMaker mortgage is the fact that PMI can be removed once you hit 20% equity. This is important because not all programs allow you to remove PMI once you hit 20%. For some programs, you'll be paying that additional PMI for the life of the loan. You do want to confirm this with the lender first, because sometimes, depending on the lender, they require you to have 2 to 5 years of payments prior to removing that PMI. One more thing to add about why I like the Chase DreaMaker mortgage is because there is no restriction on property location. Now, depending on which of these low down payment or no down payment options you choose, be mindful if some of them have restrictions on where you can purchase a home. A lot of them want you to purchase homes that are in underserved areas, which may not be where you want to live at the moment. And finally, the last reason why I like the Chase DreaMaker mortgage is because you can get up to $483,000 for a single family home, and you can get more if it's multiple units. Now, there are some downsides to this Chase DreaMaker mortgage, at least in my opinion. Although you can get a home with that 620 credit score, to get the best interest rates, you'll need to have a credit score of at least 720, which is not necessarily a bad thing, but it's something to keep in mind of if you were planning on getting those low interest rates that are out there right now and you had a low credit score. Now, another catch is lower credit scores may require a larger down payment. So if you have over that 720 credit score and you don't want to spend the money, this is great because you may not necessarily have to pay a large down payment and may still be able to qualify for that low 3 to 5% down payment rate when you're going to buy this home. But be aware that if you do have a lower credit score, you may have to put down a larger down payment than what they are advertising. Overall, I think this is a great option for those who are looking to buy a home or even their second home without putting down a ton of money, especially if you have a higher credit score that allows you to get that low down payment option. It allows you to use grants in addition to the low down payment options that they offer. There's no restrictions on where the property has to be located, and you don't need to have reserves at the time you are closing. There are a few other options in case you feel you don't fit the mold of the Chase DreaMaker mortgage, and we'll go on to that next. So let's move on to number 2 of some of my favorite low down payment and no down payment options for 2020, and that is the Choice Renovation. Choice Renovation is exactly what it sounds like, renovation. It's great for those of us who do not mind putting in a little bit of that sweat equity to do some maybe minor cosmetic repairs or maybe even some major repairs that the majority of other people will stay away from. So let's jump into some of the pros and the reason why I like this option. And for number 1, that's because of the less competition that you'll face. Now with Choice Renovation, you're most likely going to be looking at properties that require some work. So maybe it needs some cosmetic repairs like I said before, or maybe it needs some major repairs. Most first-time home buyers, or most home buyers period, tend not to look at properties that are distressed and need some work to get it up to speed. And if you don't mind putting in a little bit of work, then you can reap the rewards of getting a property undervalued and then getting instant equity once it's done and fully renovated. The main reason why I like the Choice Renovation is because they finance up to 75% of a home's value after it's repaired, being that you qualify for the total value, of course. This is important because most lenders tend not to finance extremely distressed properties. So this gives you an option to buy a property that needs work and getting for a low price. For example, let's say you find a home on the market for $300,000, but you know in that area 3 bedrooms and 2 baths usually go for $400,000. This home, you looked at it, you got your uncle that's a contractor to come look at it, and you realize it only really needs about $20,000 of work to get it up to speed. For the price of $320,000, you have a house that will be worth $400,000 because you were willing to put the work in. And I think the Choice Renovation is a great option if that's the route that you choose to take. Another thing that most people don't consider, but I think is a great tool with the Choice Renovation, is the fact that it's a single close mortgage, meaning the mortgage and the renovation loan will be financed into one closing. This beats doing 2 separate loans, 2 different interest rates, just getting all the financing done with one deal. And if you're going to purchase a single family home with the Choice Renovation option, then you can purchase that home with as little as 3% down, which also brings me to my next pro, which is they do allow you to purchase 2 to 4 unit multifamily properties. As I've stated before, and I will always state, this is what I advise: purchasing multifamily properties that allow you to potentially live for free in one of the units while renting out the other units that can help with any expenses you may incur, such as the mortgage, of course, taxes, water bill, electric bill, and maybe repairs that come up. And if you bought the deal right, you may also even be able to reap the rewards of some cash flow from that multifamily property. If you're an investor and not a first-time home buyer, you can still use the Choice Renovation option. They allow investors to purchase single-family homes with as little as 15% down. Last but not least, the Choice Renovation loan allows you to cancel PMI after 20%. And you'll see once again why this is important later on in the video. There are some cons to using the Choice Renovation option. If you were planning on purchasing a 3 to 4 unit property, then most likely you'll have to put down 20%. And I think this is something for seasoned investors or someone that has a team behind them who is willing and prepared to do the work necessary to bring a property up to speed. If you don't have any experience in rehabs, renovations, bathrooms, roofs, whatever is necessary, you may want to think twice about doing your first deal as a major gut renovation and using this loan to finance it. But if you are purchasing, let's say, a 1 to 2 unit property that needs work and you want to get it undervalued, I think this would be a great option. Now, the third low down payment or no down payment option that we could use for 2020 will be a popular one, which is FHA. For those of you who are not aware of FHA, an FHA loan allows you to buy a home with as little as 3.5% down. Let's go over some of the reasons why I like FHA and a few things that you do want to be mindful of before you take an FHA loan out. Obviously, one of the pros is the low down payment options. 3.5% is great, especially if you do not have a ton of cash on deck to go out and buy these $500,000, $600,000 homes, especially in markets like I live in. So 3.5% is a good entryway to get your foot in the door. Another pro is their low credit score requirements. You can qualify for an FHA loan with as little as a 580 credit score. Moving on to the next pro, FHA allows you to purchase properties with 1 to 4 units, which is something that I highly recommend. And you're only required to live in that house that you purchased with FHA for 1 year. So you can purchase a 3-family building, live in 1 unit, rent out the other 2 units, and after 1 year, move out of that unit and rent out the entire 3 units. And then you can collect the cash flow from whatever it's making. Another good thing about FHA is they typically offer lower interest rates than the other programs when you have a lower credit score. So just like the other programs I mentioned before where you needed a higher credit score to qualify for that low down payment or those lower interest rates, with FHA you could generally get those low interest rates even if you were to have a lower credit score. And last but not least, the main reason why I like FHA is because they allow you to get your down payment as a gift, which they outline in their FHA handbook. They outline this in their FHA handbook, but basically you can have multiple areas contribute to your down payment, essentially saving you that out-of-pocket expense. Possibly the only con and something that you want to be aware of is FHA mortgage insurance. Because most people are putting down less than 20%, chances are you will have FHA mortgage insurance for the life of the loan. This mortgage insurance could be very expensive depending on your market. There is a way to get out of paying mortgage insurance for the life of the loan, but it requires a down payment of at least 10%. Now, overall, FHA is a great product that you can use when you do not want to put down such a high down payment or you have a low credit score. But let's move on to the next options and see if one of those better suits your needs. Moving on with our low down payment and no down payment options, we have the Europath mortgage program. Europath is an interesting program that I think many people should look into, especially if you just want a single family house. For a single family house using Europath, you can purchase it with as little as 3% down. Be mindful though that to get that 3% down and that single family house, you'll have to have a credit score minimum of 660. Let's jump right into the pros of the Europath mortgage program. First up, you can get into a single family home with as little as 3% down and a credit score of 660. And just like the other programs, you do have the ability to purchase 2 to 4 unit properties with the Europath mortgage program. Another great thing about the Europath mortgage program is it does not require reserves for a single family if that single family is located in a high cost area. Now, let's get into the main reason why I really like the Europath mortgage program, especially if you're a first-time home buyer. The main reason why I find the Europath mortgage program extremely appealing is because income from non-borrower household members, such as relatives, can be used to help the borrower's debt-to-income ratio and help the borrower secure a larger mortgage. And although their income is helping you secure the larger mortgage and possibly help your debt-to-income ratio, they will not own the home. The only caveat is that they have to live in the home with you for at least 12 months, which I think is a fair trade-off. The Europath mortgage program allows you to use income from a second job with only 12 months of work history. Now, I have clients where they want to purchase a home, but they haven't been working at their job for 2 years, which is typically a standard requirement if you're looking to purchase a home and they want to verify your income. With the Europath mortgage program, you can use the income from a second job with only 12 months of work history. Just like a few of the other programs I mentioned, Europath allows you to remove PMI once the owner has 20% equity in the property. Once again, check with your lender just to make sure that you can remove the PMI once you hit the 20%, or if they require 2 to 5 years of payment first. There are some things that you do want to be aware of if you choose the Europath option. The first one is that if you want to buy a multifamily property, you need a minimum credit score of 700. One of the major cons, for me at least, with the Europath mortgage program is the fact that not many lenders use them. And out of the two that I'm familiar with, neither of them are licensed in New York. So it's not an option for me or any buyer that plans to buy in New York. But check to see if the Europath mortgage program works in your area and you can take advantage of all it has to offer. Overall, I think Europath is another great tool if you're looking for a low down payment or no down payment option in 2020. And let's move on to our next mortgage option. Now, last but not least is number 5, which is what I chose to use when I purchased my triplex, which is Naca. You should be aware of everything this option brings. Read all the fine print because there are a lot of pros and cons to using Naca in my opinion. But let's start with the pros. As advertised on our website, no down payment, no closing costs, and no credit score consideration. They do more of a character evaluation type of thing. Another reason why I like Naca is they allow you to purchase 1 to 4 unit properties. You always want to check out how many units you can purchase when you're going with one of these low or no down payment options. Another pro that I wish I took advantage of when I purchased a home using Naca is the ability to buy down the interest rates. This will ultimately save you a ton of money over the life of the loan in interest if you do have the funds to buy it down. Now, with no down payment, no closing costs, no credit score consideration, there has to be a catch, and there are. So let's discuss some of those cons that you want to be aware of before you go out and secure a loan through Naca. Now, one of the cons, or something that you want to be aware of, which was also a pro, happens to be the fact that there is no down payment. With no down payment, you are essentially financing the entire loan. So you have no equity in the property whatsoever, and you'll be paying a lot of money in interest over the life of the loan. Another thing that you want to be aware of is with Naca, you have to occupy the home for the life of the loan. Unlike with FHA, where you are required to live there for 1 year and then you have the luxury of moving out and renting out that unit, with Naca, they expect you to live there for the life of the loan. And to enforce that, they place a $25,000 lien on your property. Now, with this lien, this could pose some difficulties in the future depending on what you want to do, such as maybe do a HELOC. Because you have a lien on the property, you do need their approval on certain things before moving forward. Another thing you want to be mindful of before taking this no down payment option is Naca has something called priority versus non-priority, and this basically restricts what areas you may purchase a home in. There are a lot of factors that go into this, but the main factor I found that determined what area you can purchase in is your income. If you're a high income earner, you may still be able to use Naca, but you may be restricted to what area you can purchase in, which, as I mentioned before, is most likely going to be one of those areas that they consider to be underserved. Possibly one of the biggest things you want to be aware of if you are to purchase a home with Naca is that they require 4 to 6 months reserves if you are to purchase a multifamily property. Fortunately for me, this wasn't part of the policy when I used them to purchase my first triplex, but a lot of the clients who I work with now have difficulties coming up with these 4 to 6 months reserves when they're trying to buy multifamily properties. So although there is no down payment and no closing costs, you do need to have a good amount of funds set aside if you were to purchase a multi-unit family property. For example, say you found a house and you qualify through it for Naca and the mortgage will come out to be $3,500, which is not uncommon in New York, but you need a 5-month reserves. That means you would have to have access to $17,500 liquid cash before you can close. Even though you didn't have to put down a down payment, you still need close to the sum of $20,000 before you can close on this transaction. Reserves aren't a bad thing, but it's something that you want to be aware of, that you will need these funds available if you were to purchase a multifamily property through Naca. Now, if you are able to purchase a home in an area that you would like to live in and you don't plan on leaving that state that you purchased a home in, then Naca may be a good fit for you because the $25,000 lien won't really mean much if you plan on living there for the life of the loan anyway. Also, just because this lien is here does not mean you cannot sell your property or eventually refinance out of Naca and secure a loan with someone else. As far as I'm concerned, I have no plans on leaving New York anytime soon. If I do, then I'll simply sell a property if that works out best for me. So Naca seemed like a good fit. I also did not want to put down a hefty down payment. I also wasn't aware of all the other low and no down payment options that were available at the time when I was going through the Naca process. So would I have still done it? I don't know. So how do you plan on financing your next purchase in 2020? Are you going to use one of the 5 ways that I mentioned in this video? Or is there another program that you know of that I didn't mention? Let me know in the comments below. And if you found this video useful in any way, please give it a thumbs up. I would greatly appreciate it. And I'll see you in the next video. Peace.